tipos de las que tenemos que hablar, cuestiones geopolíticas también que se han dado en Davos, cuestiones geopolíticas que se han dado fuera de ese Foro Económico Mundial, pero antes queríamos también hacer un paréntesis en el informativo y en toda esta sucesión de noticias para pausar y hablar del mercado, del momento actual de los mercados financieros. Lo vamos a hacer con Alliance Bernstein. Tenemos a Arnaud Mounier, que es jefe de desarrollo de negocios de renta fija en Alliance Bernstein. Arnaud, thank you so much for being here in Negocios Televisión.
Thank you for having me.
Arnaud, I wanted to ask you the first question. Has Alliance Bernstein a different view from the market about the central banks, Federal Reserve and ECB, for their actions in 2023?
Well, I would say that the central banks have, of course, committed to further rate increases. We believe that the period of aggressive interest rate hike and the related shocks for investors are likely to be over. So that's the good news for investors, I would say. And so in the US, we agree generally with the market that interest rates in the short term should peak around 5%, in Eurozone around 3 to 3.5%, and in the UK around 5% as well. The difference between our view and maybe the market view is, for instance, in the US, the market is starting to price a potential rate cut as early as Q3 this year. And we think this is a bit aggressive or a bit optimistic, whatever way you want to put it, because we think that the Fed will not cut rates until they see prolonged progress on the inflation front. And what you see in the US is that US wages and the job market in the US is still very strong. And this is fueling inflation, inflation from wages. And so again, it's going to take time to see real progress on inflation. And so we are more likely to see, in our opinion, rate cuts in the US toward the very end of this year, or maybe at the beginning of 2024. In Europe, it's a slightly different story. The market is pricing interest rates to increase at the beginning of this year and then to stabilize. We think that we could have a good surprise, maybe the ECB cutting rates in Q3 or in Q4, because growth is going to slow down materially in Europe, even though the German Chancellor is trying to be positive about that. But we think that the fight from inflation could tilt toward the fight for maintaining some growth. And so that could maybe lead to a good surprise and a potential rate cut in Europe by the end of this year.
Arnaud, specifically about European interest rates, is it a good time to take more duration or interest rate risk now that rates have risen? And where do you see opportunity here in Europe?
Sure. So look, I think our game plan for duration and interest rate risk at Alliance Bernstein in the short term for Europe is to remain quite cautious. We don't want to increase our duration too much. The main reason is you still have a fairly hawkish tone by the ECB, but you also have a number of technical factors that could come negatively impacting the market. The first one is you can see that the UK and the European governments have a lot of funding needs. It's increasing significantly. And so the issuance of bonds by those governments is going to increase the supply of bond at the same time when the ECB is buying less, is terminating quantitative easing, and is starting to implement quantitative tightening. So the supply of bond will be quite unprecedented and will create some uncertainty about how the market will digest such a volume. There is also another technical factor, is that overseas investors like Japan are probably going to be less attracted by investing into European bonds, because as we saw from the Bank of Japan, the yield curve control has been somehow adjusted. And so interest rates in Japan has increased. And so there are more, let's say, domestic bonds in Japan are more attractive to domestic investors, and they are less likely to go to Europe, for instance, for yield. So all these technical factors make us a bit concerned that there could be more interest rate pressure on the short term. Now, as I mentioned, when we move toward the end of the year, when the central bank maybe needs to take into account the slower growth in Europe, we are actually going to be a bit more positive on duration, and we will likely increase our interest rate risk. Maybe after the summer is probably a good time. When we think a bit more specifically where we like to take duration, well, what we note is that in some peripheral countries like Spain, like Ireland, there is very strong quality here. Now they are trading at the same price as the French government bonds, for instance. So what you see is more Italy being a bit the laggard here in terms of potential yield. Basically, Italian yields are increasing when the bond yields are increasing, but the Italian yields are increasing much faster and much higher. And so we think that we have to be a bit cautious on Italy on the short term, but maybe, as I said, when we move to the second part of this year, if interest rates are going to probably be under less pressure, then maybe Italy can be another opportunity.
Arnaud, as most economies are forecasting a recession in Europe for 2023, are you positive on European credit assets versus another global opportunities?
Absolutely. I think, well, we look at a few things when we consider European credit markets. The first one would be valuations, obviously. And what we see when we compare European credit yields with the same yield in the US, adjusted for the cost of hedging the currency, we see there is a good premium for European credit over their counterparts in the US. And that really reflects the sentiment by the market that the economy in Europe is going to be weaker than in the US. That being said, when we look at the credit fundamentals of European issuers, when I say credit fundamentals, I mean operating margins, I mean net leverage, I mean interest expense coverage. Well, we see that they remain very healthy, at very healthy level. And so we will see some deterioration about these credit metrics, but they start from such a high and healthy level that we are not so concerned about massive downgrade or even default risk in Europe. So basically, it's true that credit spreads in Europe have tightened quite significantly in Q4. So valuations are less provocative than 4 or 5 months ago, but they do remain above average levels. So we still advocate an allocation to European credit.
The European high-yield market in particular, Arnaud, seems vulnerable to a recessionary environment. Do you expect default rates to increase meaningfully?
Well, we do not disagree with the need to be cautious with high-yield investment at this juncture. There will be an increase of default rate, but it's important to note that we are currently near 0% default following the spike we saw during COVID. So we do anticipate in European high-yield default rate to increase to, let's say, 2 to 3% annualized rate over the next 18 months to 2 years. It's still below the long-term average of default rate for the European high-yield market, which is around 4%. So to protect against that, what we do is we go on the safer end of the high-yield market, the BB rated names, even triple Bs, between triple Bs and double Bs. And we like to select high-yield sectors that are very robust, again, in terms of credit fundamentals, like subordinated debt of banks. We think European banks are very well capitalized, and even though it's going to be a volatile market, we think that they have sufficient buffer for us to invest in this part of their capital structure. So overall, we do believe that there are some part of the European high-yield market which is solid. We do avoid, on the other end, more cyclical names, more cyclical industries that are obviously going to be impacted by slower growth in Europe.
Thoughts, what is the most efficient way to think about investing in Europe according to Alliance Bernstein?
Well, according to us, really you need a strategy, or let's say a portfolio construction which is going to be very flexible, first in terms of duration management. As I mentioned earlier, again, you want to be quite prudent at the beginning of the year and then maybe more pushing your duration toward the end of the year. So we advocate strategies that are not hugging a benchmark, that can adjust duration dynamically based on interest level, but also based on the need to mitigate credit risk that you take in your portfolio. And so in 2022, last year, we saw both interest rates and credit investment performing poorly at the same time. And it's pretty rare that you don't have the normal correlation between safe assets and risky assets. What we expect for this year, we do expect this correlation between safe assets, or let's say the negative correlation between safe assets and risky assets to normalize. And so for us, if you're going to buy some credit assets in your portfolio, you need also this combination of duration to perform well. So again, we think a European credit allocation makes sense. A selective European high yield allocation makes sense, but you want some duration and you want a portfolio strategy that allows you to combine this duration and credit risk at the same time.
Arnaud Mounier, thank you so much for being here in Negocios Televisión. Have a good day.
Have a great day. Thanks.